Moving the needle on founder failure, one conversation at a time. I'm your host, Justin Gordon, and welcome to Startup 2.0 by Spark XYZ. Join us each week as we give you access to some of the top investors and entrepreneurs in the country to help you think through and overcome the top challenges that startups face.
I think there's no better place in the country to be investing than Los Angeles.
What is the problem that you're solving and for who? Like, what is that specific pain point?
Sometimes when a company is not listening to its customers and just thinks it knows better than its customers, has a really, really hard time finding product market fit.
I want to see somebody that isn't going to stop. You know, this person, you just feel like they're gonna make it work.
Today's guest is Brandon Maier, who's the founder of LvlUp Ventures. Brandon has extensive experience building financial and marketing strategies for startup companies. Brandon, welcome to the show.
Thanks for having me.
Yeah, and where I want to get started with is where are you currently at with LvlUp Ventures? And this may change depending on when this is released, but where are you currently at with LvlUp Ventures?
So LvlUp, I've been building and developing over the last 9 months. We're actively raising our first fund right now, which is set to be a $40 million fund.
Awesome. And then with that process, how does that process go? How's it been going so far? What are you kind of doing day to day to move that along?
It's actually been going extremely well, which is why we actually ended up kind of changing what we were going to be raising.
Yeah.
We built a differentiated model, which is super difficult in this space. Much easier to do with a startup than VC, but you have to get quite creative to do so. So I think that we built something that's going to be very strong in this space, and that it's very much differentiates from the typical VC's model or accelerator model where I came from.
Yeah, and to that point then too, like with the actual fund model versus the accelerator model, why did you choose to raise a fund versus maybe doing an accelerator again? Like, I'm just curious on how you chose that.
So I think one of the things that from doing an accelerator, a lot of the hundreds of programs that are out there, they differentiate slightly from program to program, but it's still the same basis of equipping early stage founders with an education component, whether that's workshops or classes. In a lot of instances, if you're doing a physical space, moving companies out for 3 months, and then you also have kind of a set number of teams depending on who's running that program that's kind of your mandate to take. And it just what it ends up doing, it's a great space to be in, but what it ends up doing is a lot of those much more established founders with those really large exits in the past, they're past that point of acceleration, especially since they've built businesses in the past. They're not going to sit through kind of that education component. Probably by this stage, they have the right financial connections that they don't, have to sacrifice paying a program fee. So for me specifically, I loved the accelerator model. It's a lot of fun to kind of, be hands-on with those teams and really be able to make a difference in kind of shaping and molding those companies. Yeah. But it's a lot of work. There's a lot of other companies that you're kind of closing off from, and we wanted to be able to kind of open ourselves up to, anybody and everybody. Yeah. But what we're doing actually is kind of a hybrid of a direct investment fund and accelerator model. So we're running a non-program date specific virtual program that is geared at allowing those seed companies that tend to be pretty small to really focus on the growth of the business while we're raising the rest of their capital. So we'll source the majority of our companies or our deal flow from other seed funds who've made investments in the past 6 months. And if those rounds are not filled, we'll essentially take them on, equip them with an investment of $150K to $500, and through the first few weeks, really kind of hone in on different components of their business. So between our full-time team and our group of advisors, we cover a gamut of different industry expertise, from marketing, branding, building out sales teams, operations, and even acquisitions. So we have that team kind of equipped to lend additional hand to those companies, and then again we set KPIs built around growth to really have them focus in on the growth, so they continue to grow with solid month-over-month numbers while we're focused on using proprietary software that we built internally to help raise the rest of their funding.
Yeah, and with that too, then what areas is LvlUp going to be focused on? Like, do you already have certain areas, certain verticals you're going to be focused on, or what are you going to go with?
So we're in it. There are definitely certain vertical focuses, but for the most part, we stay industry agnostic. There are certain types of companies with the size of the fund that we're raising that, whether it's a lack of industry expertise or it's a very financially intensive business, like a consumer tech or hardware, we're not really touching those companies.
Yeah.
There's always going to be outliers, but for the most part, we're staying away from, about 5 choice areas.
Yeah. And with the fund too, because people don't understand how this works. Like, how much time did you give yourself in the process to actually raise this fund? And will you hit relatively close to that? I'm just curious about that too.
So we gave ourselves a year.
You did. Okay.
I spent the first, like I mentioned earlier in the interview, spent the first 8 or 9 months really kind of building out the business side.
Right.
So for most funds, when they're going out and raising money, whoever you raise from, you're kind of locked into those being your recruiters that can find the best companies and know how to pick and choose the best companies.
Right.
They're not really building a brand a lot of times. And so they're just as hard to find as it is to find a lot of these startups that might, be early and they're trying to go to events and show off, having any opportunity for an investor to see what they're doing and to look at it the same way that they do with, such joy and excitement.
Yeah.
So I really wanted to focus on the brand, building out additional educational programs, which we do. We're extremely active in terms of the LA investment community, in terms of fostering community by doing monthly events, just staying extremely active for a small team so that people know what the LvlUp name is. Because I think that's extremely important in the space, is to build a compelling brand.
Yeah, especially with so many funds out there, and there's more and more all the time.
Exactly. So it's
from them?
we also we too have competition.
Yeah.
And you think about it, and you think about these amazing deals that people write about or you read about on TechCrunch, and it's not every fund would not every fund, but a lot of funds would like to be in those deals or would have hoped to find those deals. And so there's a lot of competition on the fund side in terms of, standing out and being, one of those brands that companies want to be with.
Yeah. And I know you're raising your fund right now. Obviously, you have experience in this. What is your due diligence process going to look like as you kind of go through this whole thing? Once you have the fundraise and you're looking for companies, what is your process going to be looking like?
So just starting with the quote unquote application, with an accelerator, there's a lot of questions. And again, going back to what are you going to be able to get from the best companies out there? Ours is very simple. It's like attaching a deck and just filling out a couple financial numbers.
Yeah.
In terms of the actual due diligence process, it's twofold. So there's always going to be that, human component. That's what, people are paying for, that level of expertise, to be investing on their behalf.
Yep.
But the second is a quantitative scoring model that covers various components within the business to deem whether we want to interview this company or we want to potentially move forward with them.
Yeah, and through that process too, obviously with this early stage, a lot of it's the team and how you evaluate the team.
Mm-hmm.
What do you do, or what are some of those questions maybe you asked, or the things you look for in those founders that you're going to be investing in?
So going back to, the program that we've developed, and going away from the typical acceleration model, is probably about 15 to 20% of our investments will be first-time founders.
Okay.
And the reason being, for that. It's not so much like a first-time founder can't be wildly successful, because they can.
Yeah.
It's just for most first-time founders, there tends to be a decent amount of hand-holding. There's a lot, and which is not a bad thing. There's just so many moving pieces
Right.
in building a successful, like, scalable company.
Yeah.
And once your portfolio continues to grow and get bigger and bigger, it gets harder and harder to give that personalized one-on-one attention.
Yeah.
So we're looking for founders that have past success, that have a pretty firm understanding of how, where they want to go with this business, how they're going to get there. And, that kind of comes back to us as investors doing our diligence and asking the right questions to really try to poke holes through that business and see that they really have a clear roadmap to, how they're going to get to an exit.
Yeah, and then too, you mentioned the accelerator might be a little bit earlier, but with the venture fund itself, a little bit later potentially. But with the actual business model themselves, if they have a solid team, you said poking holes in the business. Like, what are some of those questions? Like, what are you things are you looking for from that side of the business side of it, not necessarily the team side? That you're like, okay, this is a yes or this is a no. I'm just curious on your perspective on that too.
For me personally, I'm a marketing person.
Yeah.
So I really want to look at like what their sales roadmap is, what their what their strategy is around growing their marketing. Do they actually have a strategy? Because a lot of times, people are firing at the hip. They're this works, so we're doing this. It's not like we have a clear strategy or roadmap. And then there's also times where people can be way too overly prepared.
Yeah. Where
this is a much harder ecosystem for someone that's overly analytical. So it's just kind of seeing where they fall in line with, again, execution plan.
Yeah. And then with that too, so you have obviously experience with looking at different founders, different startups. What are some of those challenges they typically face, and how is LvlUp going to be positioned to help them through that as they're growing their companies?
And there's an abundance of
There's
challenges.
Many challenges.
Many challenges.
So Brandon, choose one or two or main challenges you think that, startups face.
Okay. Yeah, we can do that. So I definitely think that, again, it's going to depend on the founders. It's going to depend on the founders' like backgrounds, where their, areas of strength, which is why I covered kind of that full gamut that, we can cover anything from like the branding to the marketing to the sales.
Right.
Because it's always one of those things. It might be that they have amazing traction, that they've really, figured out how to get this business off the ground extremely quick, but their operations are a complete mess, and that it's not going to be sustainable unless that they actually have a true operations built out. And a lot of times that's, one of the areas that ends up needing to be cleaned up, because when you're starting a company, you're trying to get off to the races.
Right.
You might be missing a lot of different components. It might be that some companies are, still sending out their pitch deck to potential clients, even though that's, they should have, something like a one page or a packet that's designed for those clients. So as even those little things kind of fall at the side and they're left unattended, they start to become much larger issues. So again, it can be anything from how they're doing sales, how they're doing marketing. The operations is, a complete mess.
Yeah.
It could even be, something when we've made that investment and we're working with them, we find out, 3-4 weeks later, the reason why they couldn't close funding was that, there's certain things that are struggling within that conversational pitch.
Yeah. Yeah. And with that too, so obviously there's so many different challenges they face. And like, you've kind of touched on this already a little bit, but with LvlUp then compared to other firms, I mean, do you plan on being pretty hands-on, or is it a case-by-case basis with the investments? Like, how is that typically going to go?
So it's for the program, which is, more so post-acceleration. So it's kind of post-education. We're not focused too much on the educational components. That's why you spend in terms of touch points.
Yeah.
They have a 1 hour virtual call every week.
Yeah.
And since it's non-program date specific, like that doesn't mean that we have to select a certain number of companies at a certain time.
Yeah. Flexibility.
Yeah. So if we don't have all of the right companies in place, I can take a company 3 weeks later, another one a month later, another one 2 weeks later after that.
Yeah.
And it follows this kind of standard. We have a weekly hour call. The first week we're doing an assessment on their decks.
Yep.
I've probably, because I did all the first passes at Quake, I've looked at close to 6,000 companies over the last 3.5 years. So we'll do an assessment of their deck, make sure that gets cut down, reworked, because this is very much so, especially when you're doing anything cold, a dog and pony show.
Yeah.
So if your deck's a mess, you can have the best conversation and potentially sell them, but you might not even get a chance to sell them because like, this is the worst deck I've ever seen.
Yeah.
And it's, I'll say this, it's stupid things like that that can, stop a company from getting that conversation that they need, from having a chance to state their case. So the first thing is doing that assessment, starting with the deck, going through, various like pain points, things that they have kind of faced while doing this.
Yeah.
Looking, asking the right questions, making sure do you feel that there can be improvements on sales? Do you think there's, improvements can be made by marketing? What are you doing to track like your marketing channels? Are you actually, tracking the data? Like if you're, doing something one way versus doing it another way and seeing what works best. This is how you end up with, processes that work, is through kind of this testing. And to expedite that process, a lot of this testing you're doing while you're live.
Yeah. That's the only way you can actually make the company better and optimize the company, right? It's to your point of testing. That's what you have to do.
You have to be mindful of, this is a very, very fast moving ecosystem, no matter what you're creating. Even if you're coming out with something that's completely new, to try and keep that under lock and key is super hard.
Yeah.
So you started your business, you're off to the races. You don't have, this is not like making your first record, where your first record, you have all the time in the world to figure out what you want to say, how you want everything to sound.
Yeah.
Because after that first record, and once you're part of that machine, now it's just go, go, go.
Yeah.
With a startup, it's just go, go, go.
Yeah.
So you have to kind of intermittently find ways to, test as you're going.
Yeah.
And for a lot of founders too, this is, something where if you're a non-technical founder and you find yourself sitting around and I don't know what to do, there's still a lot in which, they can do, whether it's building out channel partnerships, whether it's having these marketing materials prepared.
Yeah.
There's a lot of moving pieces.
Yeah. And then one of the things you mentioned, that going through 6,000 pitch decks, which is a lot of pitch decks, obviously, and going through that many, obviously there's ways that you get through the process faster, and there's ways that you easily say no to certain ones. Like, what are some of those points where you go into those pitch decks where you're like, this is a no, this is a no, this is a no, to help founders out and they're making their decks in the first place?
Well, I think that one hard thing, and I've seen funds or programs that have tried to do this, is we want to be the people to give everybody feedback and be able to help them. I tried when I first started in venture to be the person that answered every single email within 5 minutes. And yeah, it gets a little much. And then you start realizing like, oh my God, I'm taking too many calls. But back to the pitch deck point. It's, part of it's looking like, what have they done? Are they launched? Do they have traction?
Yeah.
What does their roadmap look like? And obviously a part of me is looking at some of these decks and being like, this is just atrociously designed.
It's not great. Yeah.
And for some people, it won't matter at all. Again, for others, it might not allow you mentally to go to the next page and the next page after that.
Yeah.
Or if they're spilling too much information. Sometimes, I've been sent decks that are 50 pages long. They're more designed like business plans and not, again, a standard like 12 to 15 page, pre-seed to seed deck that is you dipping your toes in the water. You're letting me know enough about your business that's compelling me to want to have a conversation with you.
Yeah, and to that point, it's almost a point of laziness, because there are so many examples of pitch decks online. It's like, this is exactly what a pitch deck should be. Like,
I'm baffled by I don't want this to sound negative, but I'm baffled by the lack of Googling by people. Even if it's, I think one of the biggest things I turn to in a pitch deck is a competition slide.
Yeah.
Once like if I've seen you have traction and everything, who do you think your competition is?
Yeah.
Because for a lot of them, they might have thousands of companies that would fall in competition, but the only ones that they're naming are the companies that we all know that are like corporations now.
Yeah.
Sometimes you get companies that like, all right, here's another company in our space, and they're worth noting because, you know, they've raised a decent amount of money.
Yeah.
Not everybody might know them, but that to me is their real competition. Can they get out from under all of these others? And does the corporate like competition, have they taken, you know, too much of the space that you either believe or don't believe that, you know, there's room for another company?
Yeah.
And is this company obviously differentiating themselves enough to warrant, you know, being in that mix?
Yeah.
But yeah, it's a lack of Googling on some of the easiest things like competition. Because a lot of times I'll even mention companies that are direct competition. They have no idea.
Yeah. They just need to take the time to actually go through it and do that.
And that's what goes back to even their differentiation.
Yeah.
That moat is a lot of times even companies will think like, this is our moat. I'm like, that's not your moat. That's some other company's moat.
Right.
What are you talking
You don't have
about?
that advantage. What do you
Exactly.
It's someone else. Yeah. And going through so many companies and evaluating so many companies in your career so far, I mean, what are some of the main reasons that these startups ultimately fail? Because you know that most startups fail. Like, what are some of those reasons you see that startups fail?
So I think a big one, and this is usually the vast majority, is you run out of money. And I think one of those ways to kind of counteract that, I mean, obviously it takes a certain person that is very compelling, that can pitch and raise money and can, you know, do that flawlessly.
Yeah.
It's a very special individual. But a lot of times when companies raise money, they're like, this is going to take us for the next 8 to 12 months. And then they're, you know, when it comes to even now, they're in a perfect position to basically start conversations with no cares in the world, essentially.
Yeah.
Like, they know that once they got that money, they got to go to work. They have to make that money work. They have to be able to get to that next round.
Right.
But a lot of times they wait too long, and they're not having those intermittent conversations in between. They're not building those relationships with investors where they have an opportunity to do that as a very non-aggressive, like, coming from like, I actually want to build a relationship with you, and I'm not looking at you like you're a check.
Yeah.
When you get into that mode where, you know, it's 3 months, 2 months out, you're going to run out of runway. One, that shows it's a negative piece for other investors because your run rate for subsequent months is not there.
Yeah.
And if there's no one else committed in this round, it's hard to protect that investment. Also, when you're raising from any time, anyone's desperate for money, the most out of character things like happen with that individual.
Yeah.
And when you're doing things against desperation, it's never a good thing.
Yeah.
So it's always be raising. Like, even if it's just like, we just raised $1.5 million,
Yeah.
we're continuing to have conversations.
Yeah.
People know us, they know what we're doing. And I even have some of the companies I work with actually create this investment chart, so that all the conversations that you've had over time, whether if you can dig in for specific information, like, is there a specific MRR that you want to see us at?
Yeah.
Is there a specific place where a company within this industry vertical needs to be? Is I have them collect all those notes, and I actually have them build out a chart, and every month they update it based off where their numbers have gone. So they basically kind of get an alert. We should probably reach out and at least restart conversations. I haven't talked to Jeff from such and such fund in 6 months. Let's let him know how we're doing, and this is all, with the, monthly or quarterly investor updates that people do with investors that are kind of in that channels, or have said, send me updates, let me know what's going on.
Yeah. And one thing to that point then, with with basically founders having to always raise more money and not run out of money, and then the balance between that and then also growing their business and actually working on their business. I mean, what do you tell them? Do they have struggles with that? What do you tell these companies then?
Well, if you do it in the way that you just raised capital, and I'm not saying you have to go out next week and start building new relationships, but let's say you know, a month later, you're still at different events, you're still, you know, kind of working through contacts. Like even I want to get in this person's inbox. I want to at least start a conversation. Again, if you're coming from a non-aggressive place where I'd love to grab coffee, I'd love to have a conversation, we're not raising right now, but you know, want to keep
for the future.
Keep them, exactly.
Yeah.
It comes from a place where, you know, even as an investor, it's non-threatening.
Yeah.
You're not going to get in some conversation where this person's just like, will you give me money? Like,
right.
You can have a legitimate like conversation. There's a way to now build that relationship.
Yeah.
It's a little bit more personalized.
Yeah, and it's almost like you have to just keep it as a startup founder top of mind that you need.
Yeah,
to
and so
money.
it makes that whole process when, you know, you are set to maybe run out in 8 months or a year. Now you have this entire pipeline that you've been building for months.
Yeah.
While again still focusing on the growth of your business, and you've made that process. If you decide, you know, 3 months when we're going to run out, we're going to really start on this raise.
Yeah.
You know, you have conversations set up. Things will be a lot easier than, crap, we're running out of money. We need to raise capital, and you know, we might be running up against the clock, and we're going to make a lot of mistakes potentially.
And now we'll take a quick break and hear from our sponsor, Brex. A big heartfelt thank you to Brex, who without their support, this show would not be possible. We've seen firsthand the difficulties accessing basic corporate credit without providing a security deposit or personal guarantee early on. As companies grow, managing expenses has become more difficult and time consuming, which is why we've partnered with Brex to offer a corporate credit card that is not personally guaranteed, offers higher credit limits, provides auto reconciliation, and integrates with ERPs using receipt capture. Brex is the credit card of the startup ecosystem, and we highly encourage you to check them out. And back to the show. Brandon, what are you most excited about in terms of investing coming up here in the near future?
I would say in terms of direct spaces, I mean, we really love SaaS companies, enterprise. There's definitely a lot that's compelling within the AI space. You know, anything that can kind of, you know, even set to improve overall economies.
Yeah.
But in general, I think we're just excited about getting ready to invest in the new year, and you know, really, we've been testing this model for 8 months, so we're just really excited to make those initial investments and find some really compelling companies in that process.
Yeah, and everyone kind of has their own process for even finding companies, or their own process for like looking at different industries. But what do you do in terms of how are you looking at new opportunities, or where the future of everything tech or everything business is kind of going?
I think that's kind of a team as a whole, like, initiative.
Yeah.
Everybody, I think this goes for a lot of investors. Like, you stay in tune every day with, you know, what's the new articles coming out on the major publications.
Yeah.
You know, keeping your eyes and ears open to, you know, what's going on, what's continuing to pop up. This way, just like any startup, and then we continue to do our research on new funds.
Yeah.
Because just like any startup, you always have to be aware of the competition that's out there. There's always going to be new compelling like funds coming out that are doing something that's interesting, whether it's an event series that they're doing, whether it's a specific workshop. And for me, having been on both sides of the table as a founder, very much so with kind of a startup mindset and personality, I'm always looking to see what's out there and you know, see ways that you might be able to take something, not take it and steal it, but really build off of it, and, you know, take these various ideas and make a hodgepodge, you know, model that works. So I always loved, you know, kind of hearing what other people are coming up with.
Yeah. And then with the venture world itself, obviously you've been in venture a number of years now. Like, how do you see that evolving, or how have you seen it evolve even recently in the last months, the last couple of years? And where do you think that's going in terms of that?
It's actually been crazy of how much it's evolved. Just starting out in New York City, this past year, I read a couple articles where New York City VCs deployed more capital than SF. Wow. I've just seen crazy amounts of ecosystems grow, and even coming out to Los Angeles, and it's almost been a couple of years since I've been here.
Yeah.
And you just kind of see this ever-growing ecosystem. You see more funds coming out. You see more and more startups, or more and more people like taking a leap to try and build a business. And a lot of these people too. One of the most interesting things to me in this space is that you have so many people that are ready to leave six-figure, very cushiony jobs because they want to create something that they see a bigger picture, or they want to be that Mark Zuckerberg, or they want to have that huge exit, and it very much so it leaves kind of a legacy for each of those individuals that can be successful.
Yeah.
So it's a very compelling space in general, but over the last couple of years we've seen venture investing exceed private equity.
Yeah.
Venture investing continues to go up because even with the emergence of so many startups, there's a lot of jobs that are created. At the same time, there are a lot of jobs that, to counteract that, that are lost because, specific technologies have, removed a lot of the brick and mortar that's out there.
Yeah. And that's always going to happen, though. I mean, it's always going to evolve.
It's always going to evolve, and you're going to, you end up kind of having through different time periods of what the general population, would be doing.
Yeah.
And so I think a lot of that has even gone to kind of the share economy.
Yeah. And one thing too, I mean, even with thinking about how the economy has been the last 10 years and how good it has been, and there is so much money involved. So there is a lot of entrepreneurs are trying to start companies, trying to raise funding because of that. And there's more venture firms, again, because of that. How has that kind of shaped what you want to do with LvlUp in terms of, you see where a venture is going, you see these more funds? How has that determined what you do for your fund and how you view that?
So, I mean, we definitely have to we do keep a close eye on what's going on in the economy, even, with everybody having a different mixed opinion, especially with this election, without getting too political.
Sure.
What's going to happen? Are we going to be headed for a crash? And that's why we even, focused and carved out the year of our raise to kind of go through next June to have the, at least half the fund there. Because if we do face any type of, economic crisis, there's always a chance that money is going to slow down, that the investments could slow down. So you always want to, and then this goes with building out a business arm, is you always want to make sure that you have a war chest and that you're equipped for crisis mode.
Yeah. You can handle the downside.
Exactly. Because I think the good thing about, living in the U.S. is that we've always had our downturns, but those downturns, for the most part, have somewhat quickly corrected themselves over time, over at least not a super elongated period of time.
Right. They've
it's not like it's like the Cold War here.
Yeah, they've had downturns and then it's come back up to a certain level, whatever that may be.
Yeah.
And one thing is,
we'll just say it's been much faster than most economies.
Sure, and some are still not where they need to
exactly.
want to be, let's just say. Yeah. And one thing, you talked about the diligence process on your end as the VC, looking at different startups, but kind of flipping that, looking at what the entrepreneur should be looking for an investor. Obviously, if you can get the capital, get the capital. But what are some questions?
There's always going to be smart money versus dumb money.
Sure.
That anybody can cut a check. Now, I think a caveat to that is you can be a little more comfortable with that anyone can cut a check once you have a solid strategic in place.
Yeah.
You don't need every single investor to, have a hand in like helping out. If anything, at certain times that can be counterproductive. So, finding that strategic, asking the right questions of how they support their companies.
Yeah.
It's just as important for startups to do their diligence. Like once, a lot of companies, their founders start a startup because they don't want to have bosses.
Yeah.
You're doing a scalable business. You're raising money. You're getting investors. That is not like really an actual workable theory.
Yeah.
So you need to know who you're going into business with. Like look at the investors from that firm's backgrounds. Like this person could potentially be really helpful. So I need to ask them this line of questioning and see if they actually they will help our company because they came out of this space, because they seem to have really solid connections. I've combed through their LinkedIn. I've done my due diligence. I think that a lot of times, especially if, this is your first company or second company, you can get wrapped up that an investor wants to talk to you. You might even just look at the check size and be like, all right, I'm sold. Okay. And you're not looking at all of those other areas.
Yeah.
Like it's important. I think it's important too, if like the founders look at their portfolio, like reach out to some of those other founders. Don't just take it from their word. Don't take it just from my word. Like see what other people's interactions like have been. These are great guys to work with. They've made several introductions for us. They've, helped us build our sales team. Like do your due diligence.
Yeah. And it seems like talking to those portfolio companies, I mean, that's probably one of the best ways you can get a feel for those VCs, because those are people that they actually work with and interact with on a daily, weekly, whatever basis. So you can get those insights from them.
Exactly. And actually, I know this is not a question, but one of the best sources, I think, for connections to VCs, if you don't have any and you're still looking for those funds, are the service providers. Yep. So a lot of the service providers around town, once you start a company, it's like every service provider is coming at you and saying like, you need our PEO service. You wait, you guys don't have the CRM yet? This is the CRM you use.
Right.
But the good thing is because they know they have so much competition, a lot of those sales reps, they'll look at what do you need? It's a two-way street of like, how can we help you? How can you help us? Like, et cetera. And that's a way to get additional VC, angel intros. Sometimes like you might be looking for a different service provider who hasn't come knocking at your door. Yeah. They deal with the service providers, deal with the other service providers as well. So they end up being a great source to build a relationship with. But I think that anytime you're building a relationship, you have to recognize as a founder, it's a two-way street, especially if you don't have a lot of validation early on. It's always good to ask like, what can we do for you? Yeah.
And then one thing too, because you have the knowledge on this as well, with founders, I mean, how long does that process take for raising capital? Clearly it's going to be different between, but like, what are your insights on that?
Average seed raise is 8 to 12 months, which is again one of the reasons why we came up with our model. Yeah. Is because we're able to expedite that in half the time, typically. And we've tested as non-broker dealers, we've tested out with companies to see that we could actually like raise that money. Yeah. In that much shorter period of time.
Much shorter, yeah.
Well, it ends up being if you select the right companies, it's really a numbers game. Yeah. There's somebody out there that's going to be willing to take a conversation, and obviously, the more compelling of a business, the more market validation you have, there's going to be a lot more of those people to take those conversations. So, it takes about 8 to 12 months typically when the founders are going out to do that. There's obviously always the outliers and exceptions there.
Of course.
But typically at that stage too, depending on the type of team or how large the team is, that's where those month-over-month growth numbers could be much better because they're not being taken out of the equation like when we work with the companies.
Yeah, and is there anything else that you would tell the founders as they're going through that? Because I mean, they're trying to grow a company, they're trying to do fundraising, and at least if they have an idea that it's going to take 8 to 12 months, that's great for them to have in their head. But what would you tell them as they're going through this process? Maybe they're still haven't gotten investment. Like, what do you tell them? Like, any advice on that going through that process?
I mean, if we were to, have a conversation, say with a company that has struggled, and I could give them any advice. I mean,
Yeah.
at first I typically ask companies, I'm like, so how have conversations been going with investors?
Yeah.
Because the typical response is like, everybody loves what we're doing. They're, we're a little too early, but like they love what we're doing, and
Yeah.
we're staying in touch with them. But that's the typical conversation of avoiding a conversation in the easiest way possible to still be polite.
Yeah.
And a lot doesn't come to that. So, the first thing is kind of seeing what their interactions have been, how they've been going about the process in general. Sometimes when they're doing cold outreach, a founder wants to tell you everything that's special about their company, and you don't know that person. People typically don't read these days. So, there's a lot of misinformation, and sometimes if you just see this laundry list email and you don't know who's like sending it, you could read a couple sentences and move on.
Yeah.
First I would just identify like what the process has been and seeing if I can offer any key insights into it, because it really just like anything. And I know the person that's not talking sitting on the other side of the table, and I'm not going to look at him. Lucas can attest to this. I had to bring up his name, but Lucas can attest to this. It's like a sales process. Like, how do you properly like build out your sales? Like there's a process, like, you even from the cold side, you have maybe that shorter message that leads into another, short message. And it's a process of dipping your toes in the water. We need it just to get that conversation. And then from that conversation, stage lights are on, it's go time, present your case.
Yeah. And then just kind of shifting gears to you now, with obviously once you raise your fund and have your fund, your day-to-day is going to be much different than it is now. But what is kind of your day-to-day now as you're in it right now?
Well, the day-to-day, it'll change slightly, but so from a consulting side, we've been running this whole program that we've built out from a consulting side, where we'll segment out investor lists. We'll build out the proper messaging and really try to save those companies a lot of time and coach them through the process. So a lot of it will stay the same. It'll just get a little lighter on, from consulting with some of those companies to actually investing in them. And it'll still be at a bunch of calls. I think I probably have 8 to 12 calls on a daily basis.
Yeah.
Just managing. We have a team in New York and a team out here, so it's just kind of managing both of those components. And I don't think much will change. It will just get busier.
Yeah, busier, more things going on.
Yeah, more juggling.
Of course. And then, why did you get into VC in the first place?
So, I've been on both sides of the table, and for me, I had different interactions with different VCs when I was doing my startup, and I did run into the occasional like VC where I'd look at their background and say our conversation was short, or they were rude. I'm like, you've never built anything. Like, how are you sitting here making this decision? Like,
right.
So I'm a very competitive person. So I kind of set myself sights on that competition, and that having that startup background, that I could do this much more creatively.
Yeah.
And build something that, again, differentiates from everything else, that's unique, it's special, and that it has a really solid brand behind it.
Yeah. And one of the things we had kind of touched on earlier was just with startups, one, not being lazy, but two, like Googling how to do a pitch deck and everything like that. But going back to that kind of point, what are any resources or anything that you'd suggest, anything specifically for startups to look at to help them either grow their company, do fundraising, any of that?
Yeah. So, especially if it's like a first-time founder.
Yeah.
YC Startup School is a great resource. We do something for early stage founders called Founder Shop. The reason why I mentioned those two things is that for a lot of people who graduated college 5 to 10 plus years ago, or even they, say they didn't go, entrepreneurial education at the school, most schools did not exist. So what most people have, if this is their first interaction with a startup, is a very siloed education. And it's, a friend telling you to watch this TEDx interview or to read this book. And as you go across kind of those different pieces and recommendations, you're looking at varying opinions, because this is very much an opinion-based, space.
Yeah.
And there's different methodologies for success. Some will work for people, and some will work for others, and some won't. So I've definitely, tell them to find some sort of kind of like entrepreneurial like boot camp that can kind of teach them the basics, so it's not as much, on the job training. It's still very much that, but
but those are some places to start at least.
Yeah, and if it's like, if you don't know how to, do marketing, like, again, being very resourceful, like, can I source from other people? Like, what are some of the best, marketing, videos or things that have worked for their startup? If we can't really afford to do heavy marketing, what are some good growth hack guides and good growth hack videos that I can watch, or a good, book on that? Like, it's just being resourceful and kind of looking like what you're getting yourself into.
Yeah. And so, like you said, being resourceful is everything. As an
Yeah.
entrepreneur, like, you have to go figure it out. And
you have to do that in life in general.
Yeah.
Like, if you lose your job, you have to be resourceful and tap your network or go into job sites or find a recruiter. You have to be resourceful to make sure that you're able to lock in another job. It's anything in life.
Yeah. And Brandon, where can people go to connect with you or learn more about your fund?
People can email me, Brandon at LvlUp, LvlUp.vc. They can visit LvlUp.vc to check us out, see what we're doing.
Awesome. Thank you so much for coming on the show, Brandon.
Thank you for having me.
Thanks for checking out Startup 2.0 from Spark XYZ. If you want to learn more about startups and investing, you can check us out and join the ecosystem at sparkxyz.io.